See, people will pay for shares based on what the earnings of the company is. So who's ever heard of PE ratio? PE ratio is simply the price that the market is willing to pay for a share in relation to the amount of money that the company is earning per share. See, when you buy shares in a company, you are actually a part owner of that company. So any earnings, in other words, the profit of that company, is yours for the proportion of shares that you own in the company. So therefore, the PE ratio is simply a comparison of how much you're paying in price for the share in relation to the earnings per share. So another way to think of this is, the bigger the P in comparison to the E, the worse the deal you're getting. Because you're paying a high price for not much earnings for the company. Yeah? And the smaller the P in comparison to the E, the better value that you're buying. Now, Warren Buffett, who's the wealthiest investor in the world, and he's done it entirely out of the share market, he says you can pay, say, $100 for a particular share and have that be cheap. Yet you can pay $2 for another share and it could be extremely expensive. Do you get the point? Because it's the comparison between the P and the E. So what I'm suggesting to you is, if this share continues to get to this P and that P is too big for the E, the market will go, hey, I'm paying too much. Another way to look at it is this. If you have, is this too much information? No. If the price is, say, at, in this case, it's $15. Oh, that's hard to do. Can I use simpler numbers? Let's say it's at $20. And the earnings of this company is $2 per share. Then that would give you a PE ratio of 10. Now, what I'm suggesting is, the higher this number is, the worse the deal that you're getting. In fact, if you're paying $20 for a share that's only earning you $2 per share, because remember, any shares that you own in the company, the profits are yours because you're a part owner. So if you pay $20 for a share price and you're only getting $2 a year in earnings, how many years is it going to take you to get your money back? 10 years. Whereas if you are only paying $2 for a share earning $2 a year per share, the PE ratio would only be 1. Would that be a good deal? Yep. Absolutely. Okay, good. Fantastic. Love that stuff. Just love it. Okay. So, that is often the reason why share prices will reach certain price levels and go down. So what will cause it to break past that is if what goes up? Earnings. The earnings of the company. In other words, they introduce a new product that absolutely kicks butt. Or they get a new manager in, or they get more market share, or they buy another company and that makes them stronger, or they get their costs down through smart economics, or a whole bunch of things. Do you get what I'm saying? And as soon as their earnings go up, the market goes, oh, good deal, really good, low PE. Okay, very good. Okay. Now there's two factors involved. There's general market cycles that will influence share prices. Also, the individual company and what they're doing. See, there are times in the economic cycle when a company is actually doing no better, but people are just very excited about the share market, and people will actually be buying shares at overinflated prices. So no wonder you then get a market crash, because they go, hang on a minute, we've been buying this shit for years. How much is the company actually making? Not much. And so the people who know what they're doing, the institutional investors, will say, hey, what a great time to take profits, because these dummies do not realise that they're overpaying at the moment. So let's get them now. And they start to sell, and then the market reacts to it.